Hertz wasn't the only rental car company betting big on electric vehicles, they were just the first. But today the entire rental industry, Hertz, Avis, Sixt, Avis Enterprise, is facing a massive, unexpected problem. They're losing billions of dollars on EVs. Hertz alone, a $2.9 billion annual loss. Sixt dumped all their Teslas from their fleet. Avis, quietly scaling back EV purchases, and across the industry, one question keeps coming up. What went wrong? And how did the rental car EV revolution collapse so quickly? To understand the full story, we need to go back to the moment electric cars seemed like the future and rental companies were desperate for a comeback. In the early 2020s, EV hype was everywhere. Tesla stock was soaring. Governments were announcing bans on gasoline cars. Every automaker had a billion-dollar EV plan. And rental companies? They saw EVs as their chance to reinvent themselves. Hertz announced 100,000 Teslas, 65,000 Polestars. GM EVs coming later. This was supposed to be the future of rental fleets, but Hertz wasn't alone. Sixt ordered huge batches of Teslas across Europe. Avis introduced EV rentals in major airports. Avis began building charging hubs. Enterprise launched corporate EV programs. This wasn't one company betting big. It was an industry-wide race. Why? Because on paper, it made perfect sense. EVs promised lower fuel costs, lower maintenance, longer lifespans, higher customer appeal, environmental branding benefits. Rental companies believed EVs were going to make their fleets cheaper, simpler, more profitable, but every one of those assumptions would soon collapse. EVs don't need oil changes. EVs have fewer mechanical parts. EVs should be cheaper to maintain. That's the theory. The reality? For the rental industry, EVs became maintenance nightmares. Hertz was hit the hardest, publicly admitting EV repair costs were 20 to 30% higher. Collision expenses were materially above expectations. Tesla crash rates were significantly higher than gas cars. But behind the scenes, other rental companies were seeing the same thing. Sixt reported their EVs were uneconomical to maintain. Avis told investors EV maintenance was unexpectedly high. Why? Because rental drivers are not gentle. EV torque is instant. EVs accelerate faster than gas cars. Renters often have zero EV experience, and when you combine renter inexperience, high-performance EVs, complex repair systems, limited technicians, limited third-party parts, you get an industry-wide disaster. Even minor collisions required specialized Tesla-certified technicians, long parts wait times, expensive electronic replacements, battery scans, calibration of sensors. A simple bumper scrape on an EV could cost 5 to 10 times more to repair than a gas car. Rental companies quickly realized EVs were spending too much time in the shop and not enough time earning money, and that was only the beginning. EVs were supposed to increase demand, but renters weren't ready. In Hertz's internal reports, many customers refused EVs entirely. Others demanded swaps. Some couldn't find chargers. Some didn't know how to operate the screens. Many panicked over range anxiety. This wasn't just Hertz. Across the industry, Europcar surveys showed low EV customer satisfaction. Sixt reported range confusion as a major customer issue. Enterprise said most renters preferred gas cars for travel, because the truth is, vacations and business trips aren't the time to learn a new car system. And charging? A nightmare for renters. Slow chargers, long lines, broken stations. EV charging infrastructure simply wasn't ready for mass rental use. Result? EV rentals sat unused while gas cars were constantly sold out. And if EV demand falls, something even worse happens. Depreciation explodes. Rental companies make money in two ways: renting the cars, selling them after a few years. If resale values collapse, the business model collapses. And that's exactly what happened. EV prices didn't just drop, they crashed. Why? Because automakers cut new EV prices to fight competition. Tesla slashed Model 3 down 6%, Model Y down 11%, Ford cut F-150, Lightning down $7,000, Mustang Mach-E down $10,000. Volkswagen admitted they massively overestimated EV demand. Chinese EVs flooded global markets at lower prices. Result? Used EV values plummeted. Rental fleets saw billions in losses overnight. Hertz publicly acknowledged over $245 million in depreciation charges in just one quarter. Sixt announced they were selling off their EVs due to negative resale trends. Avis told analysts EV resale was not aligned with expectations. Across the entire industry, the EVs that were supposed to reduce long-term costs became the single biggest financial risk in rental history. Rental fleets have one of the most delicate financial structures in business. Every vehicle is tied to asset-backed loans. If values fall, lenders demand more collateral. This happened to Hertz in 2020. Example, a 1% drop in used car values equals $75 million loss. And with EVs, used prices dropped far more than 1%. So rental companies saw margin compression, higher interest costs, lower resale returns, higher insurance costs, higher repair downtime, lower customer demand, a complete economic breakdown. By 2024, Sixt exited Tesla purchases entirely. Hertz sold 30,000 EVs. Avis quietly shrunk their EV fleet. Europe e-cars slowed EV adoption plans. Enterprise turned back to hybrids. The revolution reversed fast. Hertz brought in a new CEO, Gil West, tasked with stabilizing the company. His message was blunt: back to basics. Operational excellence, customer-first fleet decisions. And one more thing, Hertz would scale back EV investments dramatically, but they weren't the only ones. Sixt executives said, "We are not buying more Teslas." Avis said, "Future EV adoption will be cautious." Enterprise stated, "Hybrids currently provide the best balance." The industry went from "EVs will save us" So what went wrong? EVs themselves aren't the problem. The problem is EV infrastructure, EV depreciation, EV insurance, EV damage costs, EV customer readiness, EV fleet economics. These things weren't ready, especially not at the scale rental companies bet on. EVs are fantastic for daily commuting, city driving, home charging, private ownership. But for the rental industry, where every mile, every charge, every repair, every renter mistake affects profitability, EVs introduce too much unpredictability, too much cost, too much complexity, too soon. The rental EV collapse is a warning sign, not for EVs themselves, but for how fast industries try to adopt them. The next wave of EVs will be cheaper, simpler, more repairable, longer range, easier to charge, built with better depreciation in mind, and when that happens, rental companies will try again, but this time, they'll move slowly. Test smaller fleets, analyze resale cycles, study maintenance patterns, because after billions in losses, one lesson is crystal clear. Rushing into the future is the fastest way to repeat the past. If you found this breakdown valuable, hit the like button. It helps more than you know. And if you enjoy deep dive videos about the real economics behind major industries, make sure to subscribe. We're on the road to 1 million. Thanks for watching, and I'll see you in the next one.